In this video, we're looking at Euro to US dollar on the daily and 1 hour time frames. I'll break down a long trade I took and explain why I entered it, and more importantly, whether it was actually the right trade to take. The daily chart gives us our higher time frame bias, while the 1 hour chart is where we look for entries. Let's get started. First, take a look at the daily chart on the left. I've marked a bearish candle, labeled A, with a blue arrow. This candle gives us two important levels. A 1, the high of the candle. A 2, the open of the candle. This isn't just any bearish candle. It's a structural candle, which makes these levels especially significant. So how do we know that A1 and A2 are important? Looking back with hindsight on the 1 hour chart, we can see that price repeatedly reacted around these levels. They became major turning points in the market. In other words, the high and the open of this bearish candle were exactly where price was seeking liquidity before changing direction. Now let's draw another pair of levels from candle B, marked with the red arrow. These are B1 and B2, and they're just as important. Pause the video for a moment and compare the A levels with the B levels. Do you notice anything? Price keeps moving between these two areas. That tells us something important. The B area becomes the target for long trades. The A area becomes the target for short trades. Understanding where price is likely to travel is just as important as knowing where to enter. Now let's review the long trade I actually took on the 1 hour chart. The entry came on the 7 a.m. candle. It ended up being a winning trade, but after reviewing it, I realized the trade was actually riskier than I first thought. Here's why. Let's go through the swing points from S1 to S6. First, S1 had already reached a short-term target. Once that target was hit, should we expect price to continue making new lows immediately? Probably not. So when price returned to the support area at S2, there was a reasonable chance of seeing a bounce. At that point, I wasn't expecting price to break below S1 because the downside target had already been completed. Price then moved to S3, but notice it failed to make a meaningful break below S1. Next, price pulled back to S4. Even though S2 had acted as strong support before, we also need to consider the market structure. Since S3 had already traded below S1, the probability of S4 breaking below S2 increased. What I didn't expect was for price to rally from S5, break above both S1 and S3, and then come back to take out S4 before continuing higher. Looking back, that made the long trade much riskier than it appeared at the time. Now let's look at what happened after price formed S6. Where did price head next? It moved towards level C. Why? Because level C was another higher time frame target. If you've been following along, you may have noticed the repeating pattern. Price consistently moves between key structural levels A, B, and now C. Once you learn to identify these higher time frame target areas, it becomes much easier to understand what price is trying to achieve. I hope you found this breakdown helpful. If you enjoyed the video, don't forget to like and subscribe, and I'll see you in the next one.